Welcome to the foundation. Welcome back. It's been a while. I apologize for being away for so long. I would like to welcome you to the foundation. We got another episode. It's a little late being posted, but it's going up. My name is Sot L, Seeker of Truth L, Speaker of Truth L. And it is my absolute pleasure to have you here with me. It's been a while. But we got a lot of updates, a lot of things to get y'all up to date with. Today's show is entitled, Can a Private Trust Provide Legal Tax Avoidance? I'm going to get into this. I'm not going to take too much of your time away from you on this glorious day. So with that being said, we want to start with a caveat. First and foremost, this is the foundation where we understand incorrect information incorrectly applied can get you hurt. Correct information incorrectly applied can get you hurt. So we're looking to correctly apply information that is correct, or do our dance here at the foundation as it is known. Also, as you know, and as you should know if you're new, check this out. I'm not a lawyer. I'm not an attorney. I don't give legal advice. I don't do any of that. I can't give financial advice. I can't even give love life advice. I can't give parenting advice. I can give legal advice. I'm not an attorney. I'm not a lawyer. This is not offered for legal advice. This is for entertainment and informational purposes only. I'm not an attorney. Don't believe the hype. Don't do it. I could be absolutely outside of my mental cabeza as I do these shows. It's good to be back, though. It's good to be back. So, what we are going to do with our little dancer route, we're going to jump back into the show as if it hasn't been a long time, even though it has. It's been over a month, man. It's been a while. But nonetheless, let's do a little dance. Welcome to thefoundation.com. Welcome to thefoundation.com. It's back. We got hacked and we hacked back, and then they rehacked, and then we had to reheat, refry, and then rehack. We got some changes on the website. Got some updates. Most significantly, if you were ever doing your dance with the PDF section, it's been significantly reduced. We do still have Passport No Social Part 1 and Part 2. We have the bundles for Part 1 and Part 2. We have the Foundation Trust Primer. If you're brand new, you're just starting out, and you're like, what type of trust is this guy talking about? I just heard about trust, but now he's saying there's different types of trust. I don't get it. Get the Foundation Trust Primer. That's where I would start. Outside of just checking out the shows, there's over 370 of them. You can check the page. It shows you the counter on the top. I'm not playing. But the Foundation Trust Primer is where you begin. There's a lot of information available, and people would ask me, so where do I start? What should I read? What should I check out? Like, I want to get like you. I want to understand this stuff on a level you do. Where did you start? Yeah, it's hard to say. I read everything and had to figure it out. But if I were to start and someone were to give me the proper list to begin with, like just here's the primer on trust, it would be the Foundation Trust Primer. So it's over 18 documents handpicked by us here at the foundation. It'll get you right. We also got the Foundation Trust Series Part 1, Part 2, and Part 3. So those are actual physical DVDs. We're working on getting it up on the interwebs, you know what I mean? So, but we're looking also for privacy and efficacy, as well as stability, because our site, the hackeries be hacking. But it's a physical DVD, so if you don't have a DVD player, man, you got to find one. Ask grandma, pops, unc, somebody. But these start as beginning, intermediate, advanced. 1, 2, 3, just like that. So we get into the beginner. What is a trust? How does it work out? So on and so forth. Second part, we get into more administration. Third part, we get into more advanced stuff, like higher end financial management, so on and so forth. I don't want to give the stuff away, it wouldn't be nice. It wouldn't be fair. But that's the dance. But yeah, as I was saying, the PDF section down here, y'all, got demolished. And I would say decimated, but there's a lot less PDFs. We had to clean it up, come into some, some compliance that we'll maybe get into later. But here's what I want to show y'all right here. At Welcome to the Foundation. Of course, you can find our that's the dance right here, the socials right there. Also, if you would like to book a consultation, you can do that down here, right here. Book a consultation. It says it right here. Put in your name, your email, and then do the next steps. Sign up for our email list right here. If you haven't already, right here, right under click to continue. But yeah, you scroll all the way down and you got to understand. So if you look here on this left pane, there's a new icon here and it's a key. And we didn't do this. But people can straight up sign up for trustee training. We have more than just silver tier. There's no landing page. It's not exclusive as it was anymore. And here's the deal. I do want to get into the silver tier. Most people are familiar with this, but it's a self-paced course, one-time fee, and then $9.99 a month. But self-paced course, you get all the materials you need, physical manuals sent to you, access to the trustee dissemination folder. You get stuff that's not listed in here. I'm just gonna be honest. We're gonna give you stuff that's not listed in here. But you will know how to administer and create trust. That's the thing. Most people are like, hey, you sell trust? We don't sell trust. We don't. It's against our trust indenture, actually. We have the gold tier. Gold tier, self-paced is still self-paced, but I guess the biggest thing is you get 2 monthly calls with support. You see that right here? That's monthly calls. With the silver tier, you only get private email support. But the two calls with support, man, it's for specific stuff. You open a bank account, you're looking to get a deal done, you're looking to transfer a title, vehicle, so on and so forth. Man, this gold is the dance. Gold's the dance. And you can always upgrade or downgrade. Now, platinum, you get the dance. You get passport on social with it. But here's the thing, you got unlimited calls with me. Let me highlight this. And legit, you'll get my private phone number. So I will personally be assisting you in your private trust education and the startup of your trust administration. So these are the offers that we have with regards to Foundation Trustee Training. We look forward to seeing you there. It's taken a lot of work for us to get here. This is a milestone. I want to shout out Dylan. I want to shout out everyone that's helped us to get here. Christina, Dave, Derek, anybody else that's like truly helped us to get to where we are so that we can, as an organization, perform the way we perform. I definitely want to thank you. Definitely. This is a beautiful thing. This is a movement. So, you can see I'm excited. So we rehacked the hackers and then did a dance with it. So welcome to thefoundation.com. Make sure you check that out. That's the website update. I'm going to start talking your ear off. You know what I mean? So let's get into the dance. The dancery is, we're talking about trusts. And do they, do they avoid? We know what we're talking about. I'm not a lawyer. I'm not an attorney. I can't give you legal advice. I'm not. I just want to point out this article. If you know me, you know that I go from public and official sources when I'm getting the point across, right? A, you can't say I said it. I'm just telling you what someone else said, and it's more official. B, people are more apt to believe more official sources, so that it works for me. And C, it's easily referenceable. I'm showing you how easily you can find this stuff if you're looking. Like, I know people will think about private trust and they get intimidated in some certain way. And I understand that, but really there's things happening every day that you have no idea or that you're not really familiar with. There's people racing cars every day. There's people, playing basketball every day. There's people understanding and figuring out, very large, complicated equations every day. mathematically. There's stuff happening every day. And the more you immerse yourself into a particular subject, the more you see it and how it applies to your everyday life. Really easy example is if you get a car, let's say you get a Lexus or you get a Toyota Camry or you get a Cadillac or whatever car you get, you realize once you get this new car, you start seeing that car all over. You'll see different colors of the car. You'll see it way more than you did before you had it. And that's the thing, because now you're familiar with it, and now it's easier for you to pick up and pick it out. And I just want to relate that to, picking up trust administration. As long as you apply it to whatever you're familiar with, and most people are familiar with business. Maybe they've never run a business, but they're familiar with business. They're familiar with the structure of business. There's employees, there are supervisors, administrators, there's CEOs, so on and so forth. They're familiar with what businesses need to do. And most people have assisted a business in, its production or distribution of its product or service. So when you start applying what you know to what you're learning, it really helps you really pick things up. So I just wanted to share that. But we're talking about state taxes with regards to a private trust. I'm not a lawyer, but I just want to, point this out. This is Forbes. I don't know. Maybe it's legit, maybe it's not, but it's Forbes.com. And they're talking about how wealth accumulators can use trust to avoid state income tax. So I would say that answers the question right there. But in my opinion, they make it look as though it's sort of complicated. And how this thing maybe is not such a great thing. But here, let's check this out. State income tax treatment of trust that can afford and benefit from the counsel of firms like Withers. And this is the lawyers at Withers, an international law firm, is one of those things that fuel inequality. So this is, in my opinion, a narrative transfer. Maybe you don't believe this, but if you read this, you're going to think it's true, and then maybe you start repeating this. This is false. State income tax treatments of trust that can afford and benefit from counsel of firms like Withers is one of those things that fuel inequality. Listen, we got the foundation here. I know silver tool training isn't the cheapest, but it's much cheaper than a firm of international law firm Withers and their attorneys. We don't do that attorney dance over here. One of the biggest differences between the very wealthy and even the quite prosperous is that the very wealthy don't spend all or even most of their income to live. Another big difference is that most of the income of non-wealthy comes from working. If you have income being generated by wealth that you don't need to spend to live on, sharp trust legal work can avoid state income tax on the income regardless of where you live. So let me break this down. And once I'm going to say this off the top. An individual cannot assign income to a trust, and therefore that individual doesn't owe taxes. The trust has to worry about the taxes. That's not how it works. It's not how it works. You'll get in trouble. Your life will be worse. Don't do it. Once again, an individual cannot assign their income to a trust and avoid paying taxes. Not going to happen. Don't do it. You will get in trouble. Your life will be worse. Your mood will be worse. Your temperament will be worse. So I understand why they said, people who, what does it say? Most of the income from the non-wealthy comes from working. I get that. And I get the way they're trying to, not only couch, but present, this ideology that they're trying to kick out here with us, right? All right, here's what I'm going to tell you. First, we have to understand that individuals cannot assign income. That's the only reason why I would agree with that sentence or that partial sentence, because this would imply that people who are working or people who have jobs or people who aren't prosperous and ridiculously wealthy have no use for trust. Do not believe that. That is hypnosis. That is me telling you, hey, just give up. Sometimes you just got to know when to fold them, and we're both competing for the same thing. I'm if you got to understand what I'm saying. So first, off the top, an individual cannot assign. But when we're talking about assets, when we're talking about things that are already paid for, when we're talking about a business or business income, an LLC, I don't care if you're selling doilies. My grandmother used to make doilies. You may not know what a doily is. My people's from the South, so maybe I shouldn't tell you. I'm just playing. It's a decorative, like, I don't even know how to explain it, but it's a decorative kind of woven or knitted mat that people put stuff on, like plants and pots and potatoes, yams. A doily. You know what I'm saying? So if you have a side hustle and you're making doilies, okay, let me switch this. If you have a side hustle, right, and you're making, let me be creative. You make all natural, hardwood, handcrafted and engraved walking canes. Wow. That wasn't me. I can't give that credit to me. And they're doing well. They're selling on the side or whatever. And then suddenly they just start doing very well. You get 30 orders. You get 40 orders. You're starting. Okay, now you have a business. And if you are buying all of the wood and the chisels and all of that stuff with the individual account, and all of the proceeds are going to the individual account, it is a destruction. I'm just going to say that's destruction. This is where trust can come into play. This is where even a business can come into play. And a lot of people, they'll claim their business quote or LLC income on a Schedule C, and they don't understand. When you do it like that, it makes no sense to have a business unless you're making crazy amounts of bread, and then things change. People start approaching you when you have different amounts of bread. But we're talking about state taxes, so look, okay, we gotta talk about types though. We gotta talk about types. What is this? We gotta understand what this is. U.S. Bank, 5 potential benefits of trust. So they say and acknowledge trust avoid the probate process, which is a big thing. Probate is not cool. If you've been through it, you understand. If you've seen someone go through it, you understand. Probate, man, probate. Yep. Trust provide tax benefits. And then here's where they talk about that gift exclusion. So here we go. Well, this is what I wanted to point out as well. Individuals have a gift exclusion, and people get this confused, right? It's currently $19,000 per individual, $38,000 per married couple. This is the 2025. I'm not a lawyer, I'm not an attorney, I'm not giving legal advice. I'm not a financial advisor either. Excuse me. The 2025 gift tax exemption rate is $19,000 for individuals, $38,000 for married couples filing a joint tax return. What this means is an individual can gift a trust or anyone, another individual, a corporation. I guess it doesn't matter. Any person. An individual can gift a person $19,000. The individual is responsible for any taxable liabilities on that $19,000 and whatever else that individual made throughout the year. But the person that receives that $19,000 doesn't have to be subject to any taxation because it's a gift. It's the gift exclusion. Some people say, "Oh, I give it to the trust, so I can exclude that $19,000 from my individual tax return." No, don't do that. Don't do that. I'm not a lawyer. I don't give tax advice. I'm not vested either way. Besides emotionally, as you being my brother or sister, don't do that. The exclusion applies for the receiver of the $19,000, not the giver of $19,000. There's another way though. Trust can avoid tax. There's other specific parameters, but let's move on. Let's move on because I'm not trying, as I said, I'm not trying to take too much of your time. This stuff for me is very simple. Trust that avoid state income tax. This basically talks about different states. They're talking about incomplete gift non-grantor trust. So what I want you to focus on is the non-grantor aspect of it. So there are two main types of trust that we as trustees and those who are familiar with trust and trust administration, that we generally will separate or categorize trusts into. That would be what we know as irrevocable or revocable. Irrevocable means the grantor created the trust, so on and so forth. The grantor has no power over the administration of the trust. The grantor can't change any of the indenture or can tell the trustees what to do or tell them how to. They had no power. And the grantor can't basically dissolve the trust. Just because you made it doesn't mean you can't dissolve it. That's an irrevocable trust. A revocable trust is what most people understand as a living trust. This trust is, it's not for tax purposes. It's not considered a separate and distinct entity for tax purposes. Follow what I'm saying? I'm not an attorney, not a lawyer. I don't give legal advice, not a financial advisor. But for tax purposes, it's not a separate person. It's considered a, quote, disregarded entity, end quote. I'm not a lawyer. What that means is, even though the trust makes money, it doesn't matter. They disregard the trust and they look at the grantor, the person who created it and who is the trustee. It's a living trust. It does not protect from litigation or creditors. It's not a complete and separate entity. It does protect from probate, though. I will say that. It protects from probate, which is nasty. It's nasty. Probate is nasty. But it does not protect from creditors and litigation, any type of lawsuits or anything civil or whatever. And it's not a distinct legal separate entity. Those are grantor trust, or what we call revocable trust. Now, irrevocable trusts are the exact opposite. Grantor has nothing to do with it, no powers, nothing. And it is a distinct separate entity. So here they go. Right down here, you see I and trust are irrevocable trusts. Just like I just told you. Structured as non-grantor trust for income tax purposes. So the Internal Revenue Service recognizes three different types of trust. Simple, grantor, and complex. So this non-grantor, you say that to the IRS, they're like, what? So if it's non-grantor, then what is it? Because there's two other types of trust they recognize. And people will be like, what? That's where people get, you got to know, you got to know what's going on, or you got to know someone that knows what's going on that can guide you. But it's structured as a non-grantor trust. And I wonder if they just put that in there just to be added to make people. Internal Revenue Code sections 671 through 677 provides that the powers that, if drafted into a trust document, will cause the trust income to be taxed to the grantor of the trust personally, thereby making it a grantor type trust. So if the grantor has powers, however, if those powers are noticeably absent, they don't exist. Noticeably absent. Oh, I noticed that the powers for a grantor is absent in this trust indenture. It is that simple. Then the trust will be treated as a separate tax-paying entity. This is important. A separate tax-paying entity for tax reporting purposes. This means the trust will file its own tax return and pay its own taxes. Then the income will be removed from the taxing authorities of the grantor's home state. By administering this so-called non-grantor trust, at least they called it so-called, because it is a so-called non-grantor. What is a non-grantor type trust? In a state which has no state income taxes. So we're going to talk about income taxes. Certain states do not tax personal income. So, this is where they're coming from. And, they have a real world case study. This is a trust law, PC, Borchers Casano. They got a 508 area code. Where's that at, y'all? 508. Put it in the comments. I always think it's weird when people say that. Hey, they ask a question just random, and they say, put it in the answer in the comments. I do read the comments, though. A lot of them be funny. Appreciate all the love, y'all. I be losing my train of thought. So they got a real world case study. That's difficult for me. Real world as well as rear wheel drive. That's that rear wheel drive. I gotta think about that. It's difficult. And real world. The RR and the W, they get me. Jack is married to Cindy. Currently worth $20 million, $1 million taxable income. This results in $304,550 of federal tax income, man, and $90,000 in state tax, since they are already in the highest tax bracket federally. So they're talking about the federal. So federal's done. Jack and Cindy established an ING trust. I've never heard of this, y'all. I'm just telling you. I don't know. I've never heard of an ING. I've been doing this for over 12 years, like publicly teaching. And man, I've been ministering trust over 15. I've never heard of an ING trust, but there's over 80 different types of trust, my mentor told me. And he was like, if somebody tells you that they know them all, they're lying to you. That's what he told me. Because, man, listen, since they are already in the highest tax bracket, I already said that, they funded the trust with the taxable investment, thereby removing from taxation in their home state of Massachusetts. So this is some sort of, some run around with the states. I want to get into this, though. Here, check this out. Federal, Mrs. Fidelity, trust and taxes, what you need to know. From a tax perspective, trust assets are generally classified as either principal or income. This is a great explanation, y'all. Generally, the assets the trust owns represents its principal. So stocks, bonds, real estate. In your specific situation, an unencumbered car or van or truck or what people call motor vehicle. I like to say motor carriage because car is short for carriage. People say I'm nerdy, but I am. But, if it's already paid for and it's owned by the trust, that's called principal. Income, generally, let me say this and then I'll continue reading. But income generally is the money that is generated off of the principal. So, I don't know, if you have a trust or a business that owns a truck and you use that truck to tow cars and trucks to the shop and you make money driving the truck. Okay, so technically that money was made off the principal of the trust. You follow what I'm saying? Generally, the assets the trust owns represents the principal, e.g. stocks, bonds, or real estate, and what those assets earn or produce represents its income, dividends, interest, or rent. There are complex trust accounting rules that govern the treatments of trust income, expenses, tax, and distributions, which is true. There are very complex rules. And they're very complex because there are a lot of different types of trusts. The IRS recognizes 3, but, I was just introduced to an ING trust today. So, you know what I'm saying? Just take my word for it. For income tax purposes, a trust is treated either as a grantor or non-grantor trust. Here we go, Fidelity talking about non-grantor. I should pull up the IRS. And I will in a second. Remind me if I don't. Wait, how y'all gonna remind me? My fault. I'm just playing. For non-grantor trusts, who is responsible for paying income tax depends on whether the trust is considered simple or complex. Remember? Simple. Remember I told y'all. Grantors, simple and complex. A simple trust meets 3 tests. It requires mandatory distributions of all income during the taxable year. Look. Nope. That's not the trust. How does that make sense financially for a private estate? It makes sense for a business trust, absolutely. For a private estate, though, for an asset trust, for a family trust, I don't know. A complex trust is one that is not simple. In other words, a trustee has more discretion relating to the distributions of income and principal although the trust may provide for mandatory distributions of some or all of its income. In the case of simple non-grantor trust, the beneficiaries are responsible. Ooh, I'm about to give y'all a jewel because I've been talking, and some of y'all may have clicked away, but the ones that didn't, those of y'all still with me till the end of this, I'm going to give you a jewel in just a couple minutes. I'm almost finished. The beneficiaries are responsible for paying the income tax. I'm going to highlight this. On the income generated by the trust assets, right? While the trust will pay taxes on capital gains. There's also two different types of private and public trust, y'all. This is what you got to remember. Before I get into that, lowering trust taxable liability. A distribution that would be to the beneficiary will result in a lower tax. That may be the case because the trust will take a deduction for the distribution. It's called a K-1 distribution form. And given for higher, I'm not an attorney. I don't give legal advice. I don't know what I'm talking about. Higher thresholds for individual filers depending on the beneficiary's overall income. You hear that? Higher thresholds for individual filers. The beneficiary may be a lower tax bracket. However, there are some limits on how much income for tax purposes may be allocated to distributions made to beneficiaries from a trust. This is an important concept, since the distribution to a beneficiary can be from income and or principal, depending on. So what you got to understand is, trusts, and this is a key concept, trusts, because they are distinct and separate structures and entities, they do generate expenses. And I'm going to get there, but I want to focus on the beneficiary side of this. If the trust had $5,000 in dividends and $5,000 of capital gain, even though the total was $10,000 distribution, the distribution would also be considered a combination of income and principal. This distribution would also be considered a combination of income and principal because capital gains are often considered in addition to principal rather than income for trust accounting purposes. Consider the situation where a beneficiary receives $10,000 as a distribution for the trust. If the trust had no income, the distribution would be considered distribution from principal. If the trust had only $5,000, okay, so either way, it's a distribution. And regardless if it's from principal or income, it doesn't really matter when, as I'm saying, when we're talking about a family trust, when we're talking about an asset trust. And the reason why that's the case is, if you have an asset trust and it's just holding an asset, it has title to a property, or it has title to a car or something of that nature. A car, those depreciate. And a family with a property and an asset trust, especially a family asset trust, those are for family properties. Those generally are sold. The properties that are sold, they use LLCs and they use business trusts to do that stuff. So capital gain is only realized upon the sale of the property, which will never happen because it's a family asset and it's in the family asset trust. So you understand what I'm saying? These types of trusts don't generate income, right? At least not from the production of income for the utilization or monetization of its assets. You're not monetizing your family home, and you're likely not monetizing, the car, unless you consider, I'm going to school and I'm going to monetize that education. You can get into the weeds with this stuff, but I'm just trying to stay as simple as possible. Let me move forward. We got navigating trust taxation, state income taxation of trusts. So they got into jurisdiction. Wow. Whether a state is entitled to impose income tax on a trust depends on the law of the state. And January looks at the following factors. So jurisdiction, where the trusts were created. Remember this. Where was the trust created? Jurisdiction in the administration of the trust. And now, They look at the following factors, but the existence of one of these factors does not necessarily, I'm serious, from experience, I'm not a lawyer though, I don't give legal advice, I'm crazy. From experience, this is the case. Residency of trustees, residency of trust beneficiaries. Boom. So here's where we get into, different states, whatnot. And if my voice is weird, I'm sorry, y'all. I'm on my mobile platform. This is my mobile recording system. So it's not as dope as the on-prem one. But anyways, let me move forward. So there's different states. It's really, for me, this is showing different states where how they tax trust differently. But remember, depends on the law of the state. All right. So what I'm going to do is, and because I'm recording this live, I'm not going to edit it. What I'm going to do is I'm going to bang right back to here. Because I just need to pull up these two states, right? And I'm sorry, I didn't prep for this because this is something that this is very important, and this is really a predicate. This is, a predicate of the type of trust administration that we're discussing here. There's many different types of trust, but when you understand jurisdiction, begin to separate the different types of trust into their different jurisdictions. And jurisdiction is very, 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 very important. So Article 1, Section 10 of the Constitution is very important. So I'm pulling that up. And I'm pulling up IRS types of trusts because that's a nice little document they got. So, please pardon me. And I'm having an issue. Let me skip that. We're just going to stick with this. So welcome back. I appreciate you. Appreciate you sticking around. Okay, so we got the Constitution. This is from gov.info. Govinfo.gov, my bad. So we got this right here. No state shall, right? Where'd it go? Pass any. And people be like, man, you're tripping. No, I'm not. I've been doing this for a long time. Law. My bad. I'm going to start here. So no state shall pass any law impairing the obligation of contracts. And this is why I wanted to point this out, right? Because, which one is this? This one. Depends on the law of the state. We have a conflict here. So when we're talking about private trust, generally, all the time if you're dealing with the foundation, but generally when you hear it, most people are going to say those are contracts. Those are contracts that no state can impair the obligation of. So anything that it says in the trust indentures, it's contract. It's contract law. So there's trust law that falls under state law. There's trust law that falls under federal law. There's trust law that falls under international law. But contract law. And these types of trusts, contract trusts, which are complex when it comes to the Internal Revenue Service, they recognize 3 different types. Very, very simple and very specific. They don't do the dance. Depends on the law of the state. No, it doesn't. So right there is the thing, and I'm gonna come back to that. Let's wrap this up. What expenses can be deducted? Oh, remember what I was saying earlier? Okay, so they're specifically talking about real property. So understand that what is being said right here is couched in real estate. But the question should elucidate another question. If a trust can deduct expenses for real property, what else can they deduct? Well, we got it. The administration expenses of an estate or trust that would not have been incurred if the trust or estate didn't exist. Do you understand what I'm saying? Look, these are deductible, therefore are deductible. The administrative expenses of an estate or trust that would not have been incurred if this trust or estate did not exist. Anything that a post office box in the name of the trust, a car in the name of the trust, vehicle tabs for that car in the name of the trust, any property of the trust and the maintenance of that property. That includes cars, y'all. You understand what I'm saying? It includes where if the trust has if it leases an office. You understand what I'm saying? If it leases an office, if it provides, according to the contract indenture, mobile cellular phones for the trustees and beneficiaries. I don't know. Trust makes the law. Do you understand what I'm saying? No state shall pass any law impairing the obligation of contracts. I'm giving it to you. Expenses. But I'm crazy. I'm so crazy that I asked a question of my mentor quite a long time ago, and he laughed. He was like, "You're kind of smart. Can a trust be a beneficiary of another trust?" Because according to the Internal Revenue Code, I don't work there. I'm not an attorney. I'm not a lawyer. I don't have a degree in any of that stuff. I can't give legal advice, financial advice, relationship advice, dietary advice with regards to your pet. I can't do any of that. But trusts, complex trusts, deduct their expenses according to the contract indenture, not according to state law. You understand? And a complex trust can distribute 100% of its taxable income after expenses to its beneficiary. A complex trust can also donate 100% of its taxable income to a charity and receive a charitable deduction. If you stayed, that's what I'm saying. If you stayed, because every time I get into this, I feel like I get better at the explanation side of it. Like, just kind of kicking it. Yes, trusts can legally be designated as beneficiaries of other trusts. If a complex trust can distribute 100% of its taxable income to its beneficiary, and a beneficiary of a complex contractual trust that's protected by the Constitution, it's actually technically considered a federally protected entity, according to the Supreme Court. So if that trust can distribute 100% of taxable income to its beneficiary, and its beneficiary, this is complex. And I'm not talking about the type of trust with regards to the IRS. I'm talking about the subject matter, the administration, the implications, positive and negative. But a trust executed by the law of contracts and not under state statutes, I would go so far as to say as long as it is, the administration is very, very particular of the minimum contacts and how it administers that trust, it likely may never be liable to even file a state tax return. Federal tax return is different, but when you think about what a complex trust can do with regards to beneficiaries and expenses, and I'm not saying to do anything illegal at all. I'm just saying it's time to establish your private estate. That's all I'm saying. That's all I'm saying. And I say that with love, but it's the truth. And this, this stuff will give you freedom. Definitely give you freedom. And, I think it's justice that the people. I think it's justice that the people get the truth. And, it gives me peace to know that, my heirs, my offspring are going to avoid probate. They're not going to have to deal with the state and some rando third parties, random strangers with regards to their inheritance. And, there's a lot more benefits to that. But me, I'm kind of a noble dude. I'm not really into the fame and the riches and the money. And I don't, I'm old school in that respect. It's about family first for me. And then let's do some business, have a good time. Let's handle our business, but let's be responsible. And, I think being responsible, watch this. See, watch this, how I bring this back. I think being responsible is signing up for Trustee training here at the foundation. Remember, you got the key. You now have the key. Look, it's right here on the left-hand side. We've given you the key to establish your private estate, to establish your knowledge of trust administration for generations. I'm not talking about just for you, for generations upon generations upon generations. This is the private information that stays in families. That's why we have to offer it in an educational format, because education is part of charitable activity. Look up charitable activity IRS. Education. We don't sell trusts. There's a reason we do what we do. And the way that we do what we do is how we're able to do all of it. So, if you're so inclined, but either way, just keep studying, and stay positive, and understand that this whole time, you got this. You got this. It's time to start thinking positive. It's time to start, warring against those negative thoughts that discourage you, that allow you to procrastinate, that allow you to be fearful, that allow you to, just dream about your dream instead of chasing it. And, peace of mind is knowing that, all of your stuff is well protected in private structures that are outside the purview and jurisdiction of state and federal officials. You just have to properly administer. You can't commingle. You can't self-deal. There's certain things you have to do and understand and comprehend when it comes to trust administration. And these are the things you learn in trustee training. We make it very simple. So, like I said, we have the key. We gave y'all the key. Welcome to thefoundation.com. Appreciate y'all checking out the show. If you have any questions, you can leave them in the comments or shoot us an email. What is that? Info at welcometothefoundation.com. INFO at welcometothefoundation.com. But there you go. Appreciate y'all. You have a great one. Enjoy yourself. Take care of yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night. It's important. And I'll catch y'all in the next episode of The Foundation. Peace, y'all.